Hey everyone. So in this video, I want to follow up on something that I said during our predictions video, which was posted on our channel yesterday. So if you didn't check that video out, go check it out. But the thing that I want to follow up on is in that video, I said that in 2022, we are going to see the first persistent signs of negative interest rates come to the United States. Many people may not know this, but negative interest rates are actually a feature in Europe for some time now, where if you put money into the bank, you would actually get back less than what you put in. And many people may be wondering, well, why would anybody put money in the bank? And just think that if you're a large company, you cannot put your money into mattresses, or even, you'd have to buy a lot of safes to physically put the money. There might be legal restrictions to doing it. So in other words, you have almost no choice but to put your money in the bank, and now you're getting less back than what you put in. And many people may think, well, Paul, that is preposterous. That's absolutely ridiculous. That simply should not be. It's a total ripoff. And while this may all be true, the reality of what is going on in the world is that there is a huge, massive bid for cash. Companies are holding more cash than ever. People are holding more cash than ever. I saw an article in the Wall Street Journal yesterday saying that Americans have set aside something like 1.6 or maybe $1.9 trillion worth in just savings accounts. We're not talking about money in investment accounts, in savings accounts. Part of it is, of course, the stimulus checks. Part of it is the lack of spending that 2 years of lockdown and lockdown mentality have driven. And then when you extend this worldwide, there's actually trillions more sitting in Europe and in Asia. And one reason for this that is not talked about is the fact that the world is growing older. And as you grow older, your need for more stable investment rises. Most people, for their regular daily needs, would prefer that their accounts don't swing, say like our stocks do. Growth stocks are crazy volatile. And so, this is not something that you would put a lot of money into unless you had a lot of time, or else you were willing to withstand that volatility. Or third, you were willing to take that risk. In other words, of seeing this fluctuate. The downside is that if you absolutely needed the money and it happened to be a down period, like what we're experiencing over this year, then you'd be stuck. So cash has a huge bid, as I like to put it, a huge bid as a result of demographics around the world, people's desire for safety after 2008. And then there's also been a number of events that have driven additional sort of forced savings like lockdowns. And then also Western governments have provided income support in some number of countries. Now, what this has created is a massive amount of cash that is out there that is unwilling to go anyplace. And there's really nothing that can be done with. In other words, the banks really have no capacity to lend that out and earn some positive return. And truthfully, for them to earn a higher return on equity, they would need actually less cash around. And so at some point in time, you are going to see the presence of negative interest rates show up, either straight up as a negative interest rate, or else in some sort of fee that effectively works in the same fashion, where you're being charged for your money to be held in a certain place above a certain level, and where you will no longer get back what you put in. And here's why I brought this up with respect to the predictions video. For me, all this money and then the coming of negative interest rates is going to drive a number of changes. People will start taking their money and starting to push out. If you were slightly risk-oriented, you might become a little bit more risk-oriented and push out into maybe the bond market. Others will push out from the bond market, say, into dividend stocks. Other people will push out from the dividend stocks, say, to growth stocks. And what that's going to do ultimately, in my opinion, is actually start to push a lot of money into growth stocks, because this is where you are actually seeing significant growth. And obviously, that's where we are invested in. And the other place you are going to see money move into is into innovation companies, because the companies that are simply doing the same thing again and again, not innovating, doing the same things. I mean, you can spend money there, but you're not going to get any additional productivity and get any efficiency out of it. If the demand goes down for your product or service, if you're an America 1.0 company, actually investing more money would be something that generated a negative return. So I believe what you're going to see is that all of this cash, which is being hoarded by Americans, Europeans, even in Chinese people around the world, there is going to be a price that's extracted from people for all this hoarding, which would be negative returns or high fees of some kind that act like negative returns. And that's going to push money to actually into the growth areas of the stock market, and then also into capital spending. Capital spending meaning that businesses will start to invest money to implement the Internet of Things, to implement artificial intelligence, to implement blockchain, to implement robotics, to implement 3D printing and photonics, to invest into new growing, brand new industries like space. And so you can see that there is the beginnings of a sort of a circular movement, a loop, a self-fulfilling loop, a self-feeding loop, where money that's sitting there will start to come out in search of return, both in the sort of capital spending economy and then in the stock market, both of which benefit our stocks, because our stocks are stocks that either make the technologies, these innovation technologies, or else they're implementing it and using it to actually increase their productivity and their efficiency. And the last part of this is that all of these technologies, once you get past the spending, they're all deflationary. In other words, they drive prices down for existing products and services, and they are more profitable. I saw a stat put out by our folks at ARC Innovation that said that artificial intelligence in a number of service businesses had the potential to increase productivity and efficiency by 140% over the next, I believe it was 9 years or so, by 2030. 140% is an extraordinary amount of money when you consider the size of our services economy. And then when you think about then, well, what about the impact of the Internet of Things? What about the impact of blockchain? What about the impact of the medical revolution of precision medicine, of molecular diagnostics, providing you a much more precise and accurate diagnosis when you present yourself at a clinic, being matched the right medicine from the very beginning, massive productivity benefits that come from it, which then also extend life and then also increase the demand for cash, which is why I believe that these conditions of excess cash are going to continue for a long period of time, and they will keep funneling money into innovation stocks, innovation implementing stocks. They're going to get the benefits of those innovations. And then obviously in the economy, you're going to see a massive boost in the spending for all of these innovations, because they are more productive, they are more efficient, and they are more profitable. Because many of them are things like artificial intelligence, which are software, and the boosts to your profitability, to your productivity, to your efficiency are huge. So as you can tell, I am bullish, I am optimistic, I am positive. I believe that 2022 is going to be the coming out year for innovation, for the fourth industrial revolution, for America 2.0. You are going to start to see autonomous trucks, autonomous cars, drones, robots in places, in public places, in supermarket, and other places, starting to become an increasingly common thing. And with that, I believe it is really also going to trigger this aha moment for a lot of folks who are not in America 2.0 and Fourth Industrial Revolution stocks and say, whoa, this is happening. I need to get in. And that is music to your ears, because that's what we're investing in. As they come in, they're going to be forced to bid prices up, especially after the year that we have had in 2021. So I am very bullish, very optimistic, very positive. And I know this has been a difficult year for our stocks, but hopefully you've had strong hands, and it's so important to have a positive mindset to be BOP. And I'll have another video next week. In the meantime, be strong hands, be BOP. This is Paul saying bye.